In July, South Africa's consumer inflation climbed to its highest level in 10 months. Joining us for more on the headline consumer inflation, which increased to 3.5% in July. This is from 3.0% in June, is Andrew MacKenzie, Head of Portfolio Management at Nedbank. Good afternoon, Andrew. Thank you very much for joining us on the program. So 3.5% is where we are at 10-month high. In fact, the highest rate since September 2024 when it was 3.8%. Your reaction firstly?
Thanks, Mfunda, and thanks for having us. Privileged for us to share this time with you. Nothing too alarming or anything in there to read into it in the short term. Market reaction has been fairly tame. Rand weakened marginally, but it's kind of holding the levels where we were this morning, maybe a few cents weaker. But net, in line with the expectations, CPI was forecast by most economists to come in at about 3.5%, which is exactly where it came in. It is a little bit concerning, as you mentioned, that it's sort of hitting 10-month highs. And if you look at the recent trend, month on month, I think it was up in the region of about 0.9%, which if you annualize that over a sort of 6-month base, takes us closer to the sort of 6% mark. So a little bit worrying trends in the short term, but nothing out of line with what our expectations are. We do forecast inflation to trend towards a sort of midpoint of the 3 to 6% target, 4.5% towards the end of the year, early into next year, and then start trending down lower from that. Bear in mind, inflation is a year-on-year measure, so it's always looking at what the base was 12 months ago. So that's also an important determinant in what the inflation reading is. So nothing too alarming in those numbers.
Now, if we had to be granular in our assessment of that data, it shows that household food budgets are to a certain extent under pressure. The key drivers of this increase, of course, being meat, vegetables, with beef remaining the main driver. What are we to make of this, or what can we attribute it to?
Yeah, so as you mentioned, food and non-alcoholic beverages, it is quite a big overall component of the index. I think the net number was about 4.7%. Just checking my notes, inflation did come out just now, so I haven't had a chance to study it properly. But it did contribute, food and non-alcoholic beverages, about 1% of the overall 3.5% increase. So yeah, there are some concerning underlying trends in food. As you mentioned, beef prices up 28%, so meat as a whole was up about 10%. And vegetables also up in the region of, I think, 13 or 14% if I recall correctly. So yeah, certainly some real sort of short-term alarming increases, certainly when you looking for even the stats CPI article that they released with the results mentioned that your bra is going to be a little bit more expensive. And yeah, certainly when you look at the price of meats, it does mean us as consumers are going to think about twice about the meat that we're looking at. So, yeah, again, it's hard to determine the sort of outlook for meat given the uncertainty around the foot and mouth disease that we've had around the country, but that certainly is one of the main reasons that has caused the recent uptick in beef prices.
Because one would have assumed that it's now eased. It seems to have been contained when it comes to the foot and mouth, but even with the avian flu, because even there, when there was now perhaps a bit of a scare around poultry, which would have increased the price of beef, this has also seemed to have eased, but the prices just keep increasing. So you're saying that still there is a bit of an issue around containment of the foot and mouth here?
I'm not sure if it's actually sort of specifically related to the containment of the foot and mouth. I just think it's as those price pressures build in the system, it just takes a while for it to start reflecting in the actual consumer prices. And what we as consumers at the end of the day, when we go to the shops and we look at the price of meat, it's just a knock-on effect in terms of the timing that it takes from when those issues first start arising. Obviously, you've got companies that are wanting to hold on to their margins and looking wherever possible to try and pass that onto the consumer.
All right. And then on the dairy and eggs category, we see that those remain in deflationary territory. Several of these products are a bit cheaper now than a year ago. Your views on just those?
Again, I don't want to get too caught up in the sort of bits and pieces that make up the overall inflation basket, but certainly, those, as you mentioned, eggs, maize, etc., are slightly softer when you compare them to a year ago. So net, obviously helping the overall food inflation part of the consumer inflation basket. Bear in mind, as I alluded to, I think those do make up nearly 20% of the overall basket. I think for a lot of consumers, it's probably a bigger portion than 20%. So those are real impacts that have a real impact on consumers' discretionary spend. So we are fortunate at this time that some of those items that you mentioned are negative on a year-on-year basis, but still, the overall feed, when you add the meat and vegetable increases, it negates those softer prices that we've seen in some of the dairy and eggs and maize pricing, for example.
But all in all, Andrew, you're still saying that the 3.5% is not all that much alarming, because it was something that was expected, at least most economists had expected it to be still around that 3.5 band at the very least, or even moving to 4%. So you'd say that, broadly speaking, not that alarming.
No. As I said, in line with forecasts, we do expect inflation to track a little bit higher from here. If you also have a look at core CPI, I know we've been talking about the consumer number. If we look at core was only up, I think, 3%, so from 2.9% last month. So that's stripping out the more volatile components like food and oil prices, for example, and that's showing a more subdued upward trajectory, sitting at 3%, which is more in line with what the Reserve Bank has indicated at the previous MPC, that they unofficially targeting that sort of 3% target going forward.
And doing away with the 3 to 6, but rather targeting the 3. Andrew, thank you very much for your insights this afternoon. That was Andrew MacKenzie. He's Head of Portfolio Management at Nedbank, reacting to the latest CPI data.